Okay, so we're going to talk company structures and the profit first implementation. Company structures are probably the easiest to implement because the owner is generally on payroll, or if they are taking drawings at the end of the year, it is considered personal owner's pay, and which is separate to company profit and whatever's left in the company. So that means that the tax account should be paying for the company tax. Within the book, it does state that the tax account should also pay for the personal tax as well, but my recommendation is to incorporate within the owner's pay the PAYG and super amounts so that they are treated separately, just like they would when dealt with year end by an accountant. If you're unsure of what it looks like from an accounting or tax perspective, I definitely recommend chatting to another professional who is an accountant or your client's accountant to understand what the tax plans are, because again, there are a couple of things to consider when implementing profit first. The first is to ensure that whatever the owner's pay that is being taken out of the business is the amount that the accountant or tax agent wants the owner to take out. Reason being is there can be tax implications and they can be charged at the higher marginal rate. The other thing is to ensure that there's enough PAYG put aside for anything that they take out of the business. This is the same when it comes to the profit distribution. If profit is being taken out of the company to the person, to the individual, then ensure that it's in line with their tax goals and what their accountant are working to achieve with them so that they aren't then taxed at that higher rate. That said, no need to stress out. Profit first absolutely will work within a company context and is as per the book, except we want to just make sure that the tax percentage is sufficient for the profit that will be kept within the business at the end of the year. So 15% within a company structure is not always enough. My recommendation as a starting point is 20%. This is not inclusive of GST. GST is treated as sales tax and is taken off the top of real revenue. Unless, of course, the gross and real revenue is basically the same, in which case you can combine the tax and GST in the one account if that's easier for your client. In summary, what I would recommend is that you work closely with your client's accountant to ensure that from a tax perspective, they're not at a disadvantage. However, the profit first accounts and percentages absolutely work in a company context. And just a reminder to include the PAYG and super with the owner's pay, and then the tax is purely company tax. Any questions? Comment below or reach out via email.